Hi, it's Jason from iChoice. Thanks for watching. This segment is all about saving on tax liability, which needs to be of main consideration when setting up your finances, particularly if you have a home and an investment property. You see, your home loan, as I'm sure you know, the interest you pay on your home loan is not tax deductible. It comes out of your after-tax dollars. So that's the loan you have to get rid of as fast as you can. Now, let's say that you have a bit of equity in your home and you decide to go and purchase an investment property for, say, $500,000. The wisest way you can do that is to borrow the full amount for the investment property plus the stamp duty, so $520,000. So if you walked into a bank, they would suggest, let's cross your home and your investment property together and borrow the whole 104% to maximize the loan, which let's call it a good loan because you can claim the interest on that loan while leaving your home loan small. Now, there's another way of doing that actually, where instead of cross-collateralizing the property to get the $520,000 loan, you can just borrow 80% against the investment property. So you have a $400,000 loan, and loan B for the $120,000 can be secured by your home. So at the end of the day, you still have two tax-deductible loans of $520,000, but you've managed to draw a line between the two properties and the bank doesn't have a cross-collateralized arrangement. In fact, they could be at separate banks. You must remember that what determines the tax deductibility of interest on a loan is the purpose of the loan, not what it's secured by. So it doesn't matter that that $120,000 is secured by your home. The purpose of it was to assist this $400,000 loan to get you into the investment. I would also suggest, and this is something I always recommend, and ask the question, are you going to do any work to this investment property? If you're likely to say, well, yeah, we'll actually be spending $20,000 on new carpet and new paint in the next year, I'd say, well, let's borrow $540,000, park the extra 20 in the investment offset account, leave it there. You'll only pay interest on the difference, like a normal offset account on the $520 that you owe. But you can start using that $20,000 when you make when you do the additional costs, the renovation to the investment property, and you're keeping your investment loan as big as possible without having to draw upon your after-tax home loan. So there you go, there's something really important. There's also the other thing of buying a car. Now, if you actually buy a car that you can claim on tax, sure, you can go and get a 5-year car lease or hire purchase or chattel mortgage. If using up the equity, if chewing up the equity in your home isn't a problem, you can actually get a car loan, so let's call it loan C, for $40,000 and actually have a 15-year interest only 30-year home loan, which is for the car. Now, most people would say, well, hold on, I want to pay the car off as fast as possible. Well, I would suggest, no, let's get a 15-year interest only loan on the car, never pay the car loan off to allow you to channel more and more money into your home loan, which is not, which the interest for which is not tax deductible. So one thing I'd always suggest is utilize offset accounts. Instead of reducing the balance of a home loan, it's much more efficient. Well, it might turn out a whole lot more efficient by putting money in the offset account. Remember, whether you put money in an offset account or you decrease the loan balance, it actually doesn't make any difference. You're still only paying the interest on what you use. The benefit of it is, particularly if your home becomes an investment property and that loan starts becoming a good loan, i.e. a tax deductible loan, it can stay high. You can rip out the money that you have on offset account and go and use that towards your new home, which will be a loan that you will be serving with your after-tax dollars. So, thanks very much for watching. I hope to talk to you soon. Thank you.